June 4th, 2019. It's Tuesday, 13 market moves daily. Wow, what a deja vu, guys. It just seems like exactly 2 years ago, markets were doing identical type of stuff compared to June 2017. Yes, literally just within days apart. This is absolutely amazing, guys. So here's what we're saying. Summer tech crash is temporarily on pause. And the top 3 observations from yesterday, June 3rd, are such that 3 stocks tank NASDAQ while the rest of the market is actually in the green. And it's identical market conditions to the same that I have observed in June 9th, 2017. That actually was the day when I took 12,000 to 466K, set a personal record in day trading. So I clearly remember very much everything that was happening that day. It was a move to, it was a thing of beauty. But bottom line, I'm going to actually take you through some historic charts to help you understand and make sense out of this market environment that we're going through. That I think highly resembles that of June 9th and June 12th of 2017. Now, yesterday we had a lot of talk from all kinds of places about the greater probability of lowering interest rates. And now we have big institutions who are coming out and say, well, wow, actually the drop in the rates is going to be much worse, much more significant than everybody expects. There's 2 sides to look at this. One, this could indicate that a severe depression or recession type environment is on the horizon. That would be no reason to buy in stocks. But if we study the history, anytime the rates are drastically low, it clearly creates artificial environment for the market to just continuously moving higher. So with that said, I think the initial reaction, what we're observing, the market set some pretty good bottoms yesterday, and the move higher is very likely short term. So stocks, on top of everything, are likely to reclaim the orange line. We've talked a lot about being under the blue, being under the orange. Well, I think we are about to just get above the orange line, and that would actually represent possibly a great entry on the put side. From there, for now, it makes sense to stay more on the bull side rather than the bear side with everything we observe in the markets. There's probably going to be some new announcements today about further rates talk and so on. So the market could have intraday spikes. It could have intraday spikes to the upside, to the downside. So we're expecting things to be rather entertaining today. We're expecting multiple bounces up and down throughout the day. But unfortunately, the VIX has not been reflecting all these crazy actions. So that tells us that the downside potential from here near term is rather limited. So yesterday, one of the cool things we observed was actually intraday. There was some move 13 type behavior that happened twice. And even though it's not a full-blown market move 13 or anything like that, but we did pick it up. We did notice it. And I'm going to share some detailed observations with you guys here shortly. Now, watching the bounce today, a retest of possibly level 2770, 2775, likely, who knows, maybe 2790 by tomorrow. So those are the entries we're targeting for the put side. We're not expecting the bears to just completely give up here, but there's some definite signs that the bulls are starting to come in and take some bites out of this market. As far as the earnings, since we're going to some of these historic analogies, we don't have a ton of time to talk, but the earnings we're likely to trade today. Just keep an eye on some messages that may be coming your way. It's Tiffany's and Cracker Barrel, and the strategy is the same thing. The charts are extremely bearish. If they're balances, ideally we just want to go in and buy puts in the money. The charts look just pretty terrible on both stocks. So take a closer look before the market opens at those guys. Those are daily trades, daily earnings trades that we are considering. So here's a quick lesson in history and the conditions for a bounce. So a lot of you were probably wondering, what the hell is he doing buying calls when the market is like doing all this crazy stuff, when Amazon is dropping $90, $100? Why does he want to keep buying calls? Well, if we take a look at the history, June 9th, 2017, we're going to get a clear answer to that. But let me just review these conditions, okay? The conditions as such, conditions that are favorable to a short-term bounce. And one of the conditions would be the drop is not caused by any fundamental issues with the sales or profitability of the underlying business, but rather the drop is created by outside factors such as political factors, some kind of rumors, or just a bunch of BS really that's got nothing to do with the underlying business. And that's exactly what we've gotten yesterday. The speech about breaking up the companies and FTC, all kinds of stuff, crazy stuff. Okay, but did some fundamentally change to Amazon business? Well, absolutely not. Did something fundamentally change to Google business? No, it's just the talks. It's all political. And typically what we notice, if we look at the history, these things, when these crazy drops happen to the extent of $90, $100 within a day, okay, they don't last very long, and they certainly don't continue with that type of magnitude. So typically they bounce back rather quickly, and we're going to take a look at the charts in just a second. Now, it's important to make the analysis and consider the magnitude of the drop in relation to the recent average trading range of a particular stock, or in this case, indexes and individual stocks. So when something trades, plus minus 20, $40, and all of a sudden gets a huge break like 100 that bucks lower, that is a huge drop in relation to where the stock has been trading on average over the last week, 2, 3, 4, 5 trading weeks. So you want to take that measurement in relation to the average trading range of that particular thing. And if it is exceeding it by a large amount, typically that is not going to be sustainable. In other words, when a trader looks at something and just keeps crashing, naturally what you are thinking to yourself, oh my God, it's just going to keep going lower and lower and lower. And that's exactly when you got to catch that thinking and stop yourself and to try to reason to yourself that, look, yes, it does look good now on the drop side, but you shouldn't expect things to continue dropping with such magnitude. Always expect the probability of things moving sideways. Always expect the probability that the next drop, it could be the drop, but it's not going to be likely a drop of another $90 or $100. It could be a drop of a $20 pre-market that could be reversed by $60 move higher. So always consider these things. And again, it's the magnitude of the drop that is unsustainable. And if it's a larger size drop within a short amount of time, and in this case we're talking about 1 day, 2, 3 day time frames, when you have a larger magnitude of the drop that exceeding the average trading range of a particular stock or index, it's typically unsustainable and it will reverse. So the two things to gather from point number 3 here is measure the magnitude of the drop in relation to the average trading range and in relation to the time frame. So in other words, it would be reasonable for Amazon to drop $100 within 2 weeks, maybe, steadily moving lower, like $20 drop, $10 pop, $30 drop, $15 pop, and overall over the course of the week or 2 weeks to drop $100. Sure, but we're witnessing a much greater magnitude in a much shorter time frame. So again, that is not sustainable. Point number 4, the conditions for a bounce are favorable when only a few stocks are largely impacted within that short time frame, whether it's a day, 2 days, or 3 days. So in this particular case, we have Google, Facebook, and Amazon are tanking the NASDAQ overall. So and it's just that particular group that is getting some substantial downside while the rest of the market is actually holding up. So when we're not getting just universal selling conditions throughout multiple sectors, if it's just one sector, and it's actually not even one sector, it's just a small group of stocks within that one sector, okay, often, again, that behavior will be reversed. Short term, expect a bounce. And number 5, favorable conditions for a bounce are created when key technical levels are breached. And when they breach fast, within, again, a short amount of time. And if key technical levels are breached over the course of the year, that doesn't create a condition for a bounce. But if these technical levels are broken on very fast speed, okay, like, we were just under the blue line, now we're onto the orange line. Hold on, it's just a week has not passed by yet. It's under 7 trading days. Expect a bounce. It's reasonable to expect a bounce. History shows us that in more cases rather than not, you will get some kind of short-term bounce. And our goal as a trader is to understand. So your question again is, why were you wanting us to buy calls yesterday? The goal as a trader, guys, for us is not to just understand what's happening today. Clearly, everybody could look at the screen yesterday and say, well, shit is dropping. Oh my God, we just need to buy puts. But our goal and how to make money in the market is to understand not what's happening now, but rather what's coming next. And so the next move is higher probability of a bounce. It's higher probability of a green move. And if we can calculate these levels correctly, then we stand a chance to make money. It's always trying to be just a step ahead from the market. And what most of the traders were doing yesterday, what? Well, they see stuff is dropping, so what are they doing? They're buying puts. What do you think they're going to be doing today? They're going to freak out because, I mean, so far, guys, it's 6 in the morning. I think the market, it's not up drastically, but it's up, 9 points, and that's likely to continue, and I'll show you why. So here's the deal. June 9th, on this chart right here, there's a chart of S&P 500, guys. So June 9th is represented by these orange dot right here. So here's June. Things are looking, and that's 2017. So things are looking pretty steady, nice uptrend here. Nothing really drops. Look, that's S&P 500 on June 9th. So did it have a tiny little drop? Yeah, it went down like a few points. No big deal, like 9 points or something. Okay, and look what happens the following few days. You get an up day, another up day, another up day. Basically, 72 hours of moves higher before it drops down again. But again, not really, just kind of steady, just kind of going sideways. So that's S&P 500 on June 9th. What was Dow Jones doing on June 9th, 2017? Well, look at this. It didn't even drop. If I didn't even tell you about this, guys, you would be like, man, this is just a casual day. What are you talking about? Nothing is going on. Nothing is happening. So here's June 9th on Dow Jones Industrial Average in 2017, June 9, 2017. It was actually in the green. Guys, Dow Jones was in the green. What was happening to Dow Jones yesterday when Amazon was dropping $100? It was in the green. S&P plus minus 10 points. Not really significant. Not a huge deal. Okay, so what happened to NASDAQ on June 9th? Well, this is what happened to NASDAQ. Holy shit, look at this. June 9th, 2017, look at this red candle on NASDAQ. So hold on, what you're saying, Leonardo, is S&P wasn't really doing a whole lot, plus minus 10 points. Dow Jones was in the green, and NASDAQ was doing this? This looks like the chart from yesterday. This is exactly what was happening to NASDAQ. Now, let's look at the underlying reasons why NASDAQ looked like this on June 9th, 2017. Well, hello, our friend Google, right here. Look at this bar, huge drop from 1010 all the way to like 940s, high 940s for the day. When we're looking as far as, percentage drop, right? That's actually at the time, one condition that was slightly different, guys, is all of these stocks, all the FANG stocks, they were reaching all-time highs. And I came in and I shorted them throughout the day. And the options were so cheap on them. That's why I was able to turn 12K into 466 just on that day alone. The market didn't even seem like they were crashing, right? Dow Jones is in the green, all that stuff. It doesn't look like a big deal. But the FANG stocks, the options were so cheap on them because they kept going higher and higher and higher, and they were reaching full-time highs. Then I was able to buy these Amazon puts for like 70 cents, 80 cents, sell them for $4 or $5, and I was able to do them throughout the day consistently many, many times. So market conditions are slightly different from that because what are the options? The options cost you an arm and a leg right now because, you get these crazy moves. And the premiums do spike, once it becomes apparent to everybody, hold on, these stocks are moving like crazy. Their daily average size in moves is increasing, so the premiums will jump up. So the premiums are significantly higher now because these stocks, they're not trading on their all-time highs. There's some concerns with trade wars and whatever crazy stuff you heard about in the news. But, other than that, the conditions were highly similar. As you can see, Google was dropping. What else was dropping? Well, here's Amazon. Damn, look at this candle from 2015 all the way down to like 920. Woo! Percentage-wise, it exactly represents, guys, what Amazon was doing in the last 4 days, right? Amazon is down a couple of $100 in the last 4 days. Well, that was represented right here, same percentage basis, if you put that together on June 9th. Now, important to understand is, okay, so the drop in NASDAQ, while the other indexes were steady or even in the green, it was caused by the drop in just a few key names like Facebook, Amazon, Google, so on, your FANG stocks, right? The key is to understand, why were they dropping on June 9th? Well, there was nothing. I mean, there was nothing happening. There was nothing fundamental wrong with the companies, just like there was nothing fundamentally wrong with these companies yesterday. So just sometimes the market will lose its equilibrium, things will get a little bit out of place, and that creates some buying opportunities. And that's why if you turn on your TV, probably a bunch of funds are telling you, oh, hey, we're buyers here. They're buying the dip. And so that is actually represented in these candles. When you see a candle, what kind of candle is this, guys? For those of you that took your time to study the chart's divergences and patterns, you would know that this is a bullish reversal candle with a wick sticking down right here at the bottom. That's exact opposite of a bearish reversal candle, right? So the idea is to understand what happens after June 9th, 2017 in order to understand what is likely to happen here over the course of the next few days, few weeks, and predominantly if you study these charts and these time frames, you will see that the market after this big day down, they bounce. Now notice they don't make it easy on the bounce side, right? Because there's still some challenges. The next day they open lower, higher, they struggle, but finally, you know, the uptrend is created, and like a month later, we're finally retesting the same levels, you know, 950s, you know, get pretty close to where we were. But notice, there's a number of days moving higher here. We're not saying, however, there's going to be multiple days higher from here, but we're just focused for this week that there could be next 48 to 72 hours higher in the markets. Okay, so the second thing is to understand is where the markets are technically, and let's just do a quick review here on the S&P. So a few days we've noticed that S&P finally dropped below the orange. We've talked in the last few videos about how S&P at times will do that. Institutional investors will actually come in and buy this dip just slightly under the orange line. Now, as long as we don't stay there for multiple days lower. So yesterday, look at the kind of candle that was formed on S&P 500. You see that tail sticking out. It's just a less dramatic candle on this chart because we're looking at a longer time frame, but it is the same idea. It's the same type of candle that you guys would see on this drastic picture on Amazon on June 9, 2017. It's the same type of candle formation. Look at this. June 9, June 12th. Look at this formation of the candle. So it's the same thing. It looks like we're showing some signs yesterday going into the close that there are buyers that are starting to come in. And what they are going to do, they're going to try to carry us above this level of 2,700, which coincides with this orange line, maybe 2,775. We could try to move up all the way up against this 2,800 in the next few days. So these are the levels to pay very close attention to. So we're expecting, yes, a quick bounce, possibly today, 27.75. That would be an area for us to pay very close attention to. So the same thing observed in NASDAQ, right? It finally dips below the orange line, and so far, it's got 2 days under the orange. But look at this formation. It's not quite vivid, but we're getting a little tail here, which begins the bullish move, which could last for, you know, a few days here. So we're expecting a bounce back on NASDAQ back to this, you know, 75.21 potentially. and it could happen over just a number of days. Now, Amazon, just a few days, we were under the blue line, as shown on this chart right here. So look, we're just a few days under the blue. Within days, like within a week, okay, yeah, we noticed Head and Shoulders said it was going to drop, all that good stuff. But the bottom line is this. Look what happens. We are getting within that time frame from where we were just a few days under the blue. Now we're under the orange. And look at the time frame. The time frame of that happening is just, it's not weeks, it's just days. So when you get in a major break lower like this, a bounce is to be expected. So it could have done this. Amazon could have done this, guys. It could have done easily 3 days of drops equating to about 30 bucks a piece or $33 a piece, right? But instead, it just did one drop equating to about a $100 drop in one day. It just decided to get it all done. Wouldn't it be nice if it decided to do that for us on a Friday? Yeah, sure it would be. But no, it decides to do it on a Monday. But bottom line is this. After a huge move in relation to the average moves, expect a bounce from here. We're targeting a level, as you can see clearly. We're expecting the markets and Amazon to regain its posture slightly and get to this 1753 level. So we're targeting a bounce to 1753. For those of you that had the guts to buy calls, ideally want to start taking profits. We don't even want to wait till it gets to 1753, so maybe 1740 to 1753 area in that range. Take some profits today on the 1700 level calls on your Amazon positions. But here's a quick summary, right? So the speed and time frame of the drop will often create natural conditions for a bounce. So the move from just under the blue line a few days ago to now being under the orange line happened so fast for Amazon within a very short amount of time. And history shows us that this results in a bounce more often than in a further drop. And as you can see with all the historic examples I've shown you, the drop does materialize again, but not instantly, not the next day, not the next few days. The drop does materialize a few weeks out. And so we have a chance this summer to where that can actually repeat itself. So we'll keep monitoring everything daily, weekly, and we'll nail it. But going back to the tunnel, because a lot of you guys have been asking me questions last night after the market closed, like, hey, what's going on with these levels? So the levels now, we're likely to get back here to 27.99 and retest these higher levels. And what we ideally want to do, so this is where we were yesterday. Yesterday we said we are going to retest this level of 27.31. We've tested it twice yesterday and we held that level pretty strongly. So at this point, here's the current tunnel. The current tunnel is target one of the tunnel is going to be 27.70 on the upside. So here's the lows yesterday, 27.28. We'll still call this level 27.31 because that's really kind of where that main level is. 27.31 would be the lower tunnel range. 27.70 would be sort of the middle range of the tunnel, and we're likely to test that today. And then possibly, if further good news break out and worldwide markets stabilize somewhat in Germany, Asia, and so on, we're likely to get back to this level of 27.90, 27.99. We're not saying we're going to get there all in one shot today, but we're going to monitor the conditions once we're at 27.70 to really get some good clues whether we are going to get a reversal before an attack on this level of 27.90, 27.99, or if we're going to get a reversal in a reverse for another number of days before a stronger bounce. So keep these numbers in mind, guys. Write them down. Take a picture of this. Print this out. So when we get to the 27.31 level, you want to close your puts. Until we're working our way higher to these levels, you want to stay in the calls. When we are reaching these levels, you want to close out your calls and collect profits. Market move yesterday was a move 12, guys. I know a lot of you were staring at the chart yesterday. You were like, man, what kind of move is this, man? This is just getting too tricky. And yesterday's move was a bit tricky, guys. But again, I'm going to show you some characteristics to make it easier for you. It was a move 12. And what do we know about 12? 12 is actually a smiley face. It's a bullish move. It actually tells you, look, I know it looks like a crash, but it's really nothing to worry about here. It's not like an actual full-blown crash. So think of a 12 as actually a prediction of a further upside, or at least slight temporary upside in the market. So move 12 often will initiate and close at the same level where it started the day. So here's the opening part right here. Here's the closing part right here. They are literally at the same level within just a couple of points away. Here's the eyes that I drew. There's no significance in that. It just helps me remind myself that, hey, this is a smiley face and there is no further drop near term. So after hours, there's another way to look at this. If you take these levels and you draw them out a little bit further out, what you'll have is this level where the day basically initiates pre-market, and these are kind of the level that we hold in after market is closed. So same smiley face here if you combine the after hours and pre-market action as well. Now here's the most interesting observation from yesterday, guys. A move 13 behavior observed. I'm not sure if you were in front of your computer at these moments. You should have clearly witnessed the magnitude, the speed of this intraday behavior, because that's the behavior of a move 13. Things are happening lightning fast. It just looks like things are dropping, and then boom, the next thing you know, they're reversing, they're flying higher. We have two instances in the day yesterday like this. Check this out. So first we have, right after we open, we have a bounce, huge drop, followed by a huge, even a much higher reversal higher. So that's a behavior of a move 13. And then later in the day, we're dropping like a rock very, very fast, hitting this low of the day, staying there for a couple of minutes, and then huge reversal, right? So huge reversal higher. So identical behavior in the morning, identical behavior at the end of the day. This right here tells us a story that the buyers are starting to come in, that they're using these levels to actually reverse the market. If we look at the sequence of the market moves, they're actually telling us there may be a shift in the behavior from bearish to bullish short term. So the most important thing again is to look at the time frame of these huge intraday reversals. Look at, like, they happen pretty much instantly within just a matter of minutes. We get a huge drop followed by huge buying. Huge drop followed by huge buying. Like, this is a behavior of a 13. Now, it tells us that short-term reversal is likely, but it is not your full-blown, guys. For those of you that are trying to master the 13 market moves, just review the move 13, right? Because in the real move 13, the pre-existing conditions are such that the market keeps dropping for a number of days, which we do have this condition, Matt. But it's going to be your climax day where things are dropping, you get a huge drop, but not just in a number of stocks. You're going to get a huge drop across all indexes. They're going to gap down like crazy on huge volume, and shortly after that is done, they're going to bounce like crazy, and they're not even going to drop. So typically in just a full-blown move 13, you will get this in the morning, and it's not going to repeat itself again later in the day. But so this is not a full-blown 13, but it is clear behavior of a 13 that should not be ignored. It does tell us that there could be a day higher, 2 days, maybe 3-4 days higher from here. Now, of course, if we're hitting some of these levels of resistance much faster, then we may not get subsequent green days in a row, like 4 or 5 of them. We may just get a day or two on the bounce, a reversal, and revisit of the prior level of 2731. Here's the 2-day sequence, guys. It's 312. Basically, markets are moving lower, get a gap lower, moving lower, another gap lower, and finally the market is picking itself up twice throughout the day on strong volume. 5-day sequence, 212, 11, 312. Remember, guys, that last few slides we had pretty much nothing but red action filled with these move 11s as the predominant move. Now, I know some of you are having a challenge really thinking, well, if the market overall was actually negative yesterday, wise move 12 is in a green. It's actually it's kind of a psychological thing, I guess. Many traders struggle with that. They're having a hard time understanding wise move 12 is a green move while the market is dropping. Well, just because the market is in the red, it does not necessarily mean that things are not bullish. Because you got to look at it from the perspective is what type of action are you actually observing intraday. And so in a lot of these move 12s, in the second half of the day, you'll have the market pick themselves up and not necessarily close in the positive territory, but they're going to erase a lot of the losses that were created intraday, which in itself is bullish. So now we're seeing that basically in a 5-day sequence, we're starting to observe a change, a shift in the behavior from a lot of these 11s and 3s, which is still there, but now we're noticing that there's some bullish activity coming in. Even though the market looked like they're in the green, there is some bullish activity that we're showing intraday, and it wasn't just one instance. Now we're getting two 12s not far from each other. So that tells us, hold on, people are starting to buy, and if we see further buying activity, it would definitely pay to be more bullish rather than bearish, at least short term. If we take another look at a longer time frame over the last 5 days, what you're really going to notice as well is this reverse head and shoulder that I've got highlighted here in orange, guys. And reverse head and shoulders, after multiple days lower, okay, is a good indication that this is a short-term bottom. And what this reverse head and shoulders really communicates to us, guys, is the downside is limited, which is exactly the opposite of what you may want to do when you look at, Amazon crashing $100 intraday. That's probably the last thing that comes to your mind. Oh, the downside is limited. But that's exactly what's going on. So sometimes when you see this reverse head and shoulders after multiple days lower, it tells you that, hold on, move higher is in the making here. So this is a good indication, I believe, would be helpful to anybody that really tries to study and understand these guys. Remember, reverse head and shoulders after subsequent lower days is an important thing to notice on the charts. Okay, overall, we're still in this larger move to formation unless we're going to get a break above the 2800 level. So all things being equal, we're still in a bearish trend overall. But what we did say in the last couple of videos is move 2, it doesn't just drop and drop and drop in one straight line, right? So you'll have this spikes where it looks like market actually wants to move higher, followed by a bigger drop. Go sideways to higher, followed by a bigger drop. Well, right now, we're in this part of the move of a larger move 2, where we're going sideways to slightly higher. So expect this to happen today and possibly next day or two. Basically, this is what happened yesterday. Now we're bouncing out of that. It's going to look like we're going higher. Intraday drops are expected. And then it's going to look like we're going higher again and some further drops. And overall, it's going to look like we're going higher. But we're really not moving a whole lot higher. We're just kind of sort of going sideways. And if we're hitting these levels at 27.75 and you see the volume on the buy side is drying out, if we're hitting the levels at 27.90, 27.99, and there's just no further energy for the market to break above those levels, then you know right after that we're going to get this. So we're focusing short term on this. Overall, it presents better opportunity on the call side rather than the put side. And ultimately, we're going to measure the temperature when it's going to be a perfect entry to come in and short this market again. Now, expecting VIX to actually revisit 16 handle in the next 72 hours. We are expecting VIX to come down. If the market is going to go sideways to slightly higher, VIX will come down. So it is still numerically high, but at this point, it fails to break above 20 when Amazon drops $100. Guys, if this is not a bearish thing in the VIX, I don't know what is. Amazon down $100, VIX can't break above 20. I think this is something to be paying attention to. So we did reach a high of 19.75 closer towards the end of the day when S&P was hitting the lows, but we reversed and we lost a lot of this momentum and closed at 18.86. So we didn't close at the lows of the day, but pretty damn close to the lows of the day. So that tells us there may be a temporary shift in the VIX, and the next level to observe over the next few days is how quickly can we get to 16? And maybe an idea would be if we're getting to 15.9 at the same time as S&P reaching a level of 27.90, 27.99, that would be a good moment to actually come in and buy a ton of puts again. Now we'll clearly review that, but at this point, this uptrend runs into resistance, and it would be wise to, cut any calls you have on the VIX, expect a pullback in the VIX, and then we'll just have to see if this uptrend is still going to be sustainable over the next few days, or we're going to get a break below if all these crazy talks about lower interest rates and stimulus surfaces again. If we get some positive news on any trade-related stuff. So, everything is in the cards here, but what we do know short-term is VIX is likely to drop before it resumes the move higher. Next market move for today. For today, we think there is a higher probability of a bullish move, like a 1 or a 7, where the markets open higher and then they continue higher and they close higher in relation to yesterday's close. It does not mean we're not going to get any interruptions during the day where the markets intraday could lose some of the gains, but it is likely that institutional investors will come in and they'll buy the dips throughout the day. So that is the strategy that is likely to make you more money instead of focusing on the put side. Move 11, there is potentially a spike that's coming up, and if we hit in these levels of 27.75 at 27.90 rather rapidly, and then all of a sudden the market is losing steam, then we could result in a move 11. But overall, we think that a move 1 or a 7 has a higher probability for today. Key takeaways, guys. Wait for key levels to enter positions. Wait for key levels to lock in gains in your call positions from yesterday. Become a short-term bull for the next 48 to 72 hours, or maybe less if we have clear observations of a move 11. So it really pays to wait and see what happens at 27.70. Will the selling resume, and will that result in a move 11 type formation, or possibly even a move 2 if we get a huge sell-off around 10.30? So those are the key time frames to watch. If they do buy the dip about 10.30, then clearly it's going to result in a move 7. It would pay more to be a bull here, guys. So watching for VIX to drop below 17. That would be interesting observation for the day. Guys, watch the VIX, watch the market, watch the volume, position yourself properly, expect some intraday turbulence, but overall, this is an environment where we could slowly grind higher to these key levels. So target the key levels and get ready to lock some gains on the call side. Guys, let's go. Let's make it an awesome day. I'll see you tomorrow.